Silver is entering the most critical phase of its modern financial history. In part 1, we identified 3 dates that could break the paper market: 26th November, 27th December, and March 26th. Today in part 2, we go deeper. Something unusual is happening inside Comex. December positions are collapsing, March positions are exploding. And the rollover happening right now reveals exactly where the pressure is building. This is MarketVelugu Light on Markets. Now let's start with the data. On November 3rd, December silver futures held over 100,000 contracts. By November 21st, that number dropped to 43,000, a 60% collapse. Where did these contracts go? Not into deliveries, not into closing. Almost all of them rolled directly into March 2026. March open interest exploded from 34,000 to 84,000 in the same period. This is the most aggressive early rollover into a future quarter we have seen in many years. Large traders, the ones capable of taking delivery, do not want to stand in December. They're pushing all the pressure into March. March 2026 is becoming the most important silver month in decades. Here's the question most people never ask. Who can actually take delivery on Comex? The truth? Almost nobody. Only a small group is capable of receiving physical metal. Industrial users, refineries, bullion banks, authorized participants, commercial hedgers, and large OTC traders. More than 95% of Comex participants, hedge funds, CTAs, speculators, cannot take delivery at all. They don't have warehouse accounts, they cannot take custody. So they always roll or close. And this is the key. A small delivery request, even 3 to 5%, can stress the entire system. Many assume December will be the trigger, but December almost never becomes a crisis month. Why? Because December is year-end, banks are closing books, hedge funds exit positions, refineries reduce activity, liquidity dries up. No major player wants a December delivery obligation sitting on their annual balance sheet. So in tight conditions, the market does what it always does. It pushes the problem forward. This is why December open interest is collapsing and March is exploding. March, not December, is the real battleground. Now the most misunderstood idea in the silver market. Registered silver is not deliverable silver. As of the latest November CME report, registered silver is 152 million ounces and eligible silver is 300 million ounces. But this is misleading. Registered bars include metal under lease, metal pledged as collateral, metal tied to OTC obligations, metal held by banks, metal reclassified for accounting optics. Eligible bars belong to customers. Comex cannot touch them. So how much silver can actually leave the vault if longs stand for delivery? Not 152 million ounces. The true deliverable float, based on actual historical movement, vault throughput, and past stress events, is 10 to 20 million ounces. That is the real operating capacity of the Comex vault network. And this next part is critical. In 2025, Comex handled nearly 300 million ounces of deliveries, but only by draining every external source available. SLV ETF liquidations, LBMA shipping emergency metal via EFPs. China was still exporting silver, India had no premiums, eligible bars were rapidly reclassified as registered. Today in late 2025 going into 2026, these external sources no longer exist. Now apply this to March. If March open interest reaches 100,000 contracts, which the current rollover trend clearly suggests, and each contract equals 5,000 ounces. So 100,000 contracts translate to 500 million ounces of silver. And here's the real geometry. Paper OI in March is 500 million ounces, registered metal is 152 million ounces, but the true deliverable float is 10 to 20 million. Now the critical line. If just 5% of longs stand for delivery, that will be 25 million ounces, but Comex can deliver at best 15 million. This creates a 10 million ounce shortfall, forcing cash settlements, shorts panic buying spot, future spot spreads blowing out, massive backwardation, a violent repricing of silver. Even 3% standing, around 15 million ounces, pushes Comex to its mechanical limit. At 5%, the system breaks. Not necessarily a formal default, but a forced repricing as paper loses control of physical. Now the final piece. The probability of a March squeeze is rising because the world around Comex is tightening at the same time. LBMA shipments to India delayed by T+30, India's futures curve slipped into backwardation, SGE silver trading at a premium, China restricting silver exports, SLV short interest at record highs, LBMA vaults draining for 5 straight years, no ETF inventory left to absorb deficits, industrial demand hitting all-time highs. And on MCX this week we saw the opposite. Spot fell, futures rose, backwardation temporarily eased. But easing on MCX does not change the structural picture. It shows India's physical buying paused for the week, not that supply suddenly returned. For the first time in modern silver history, physical tightness, paper leverage, and global policy are converging into a single month. And here's the probability map. Base case, just normal tightness repricing leads to $60 to $80. Stress case, if shorts scramble for metal, price could hit $100 to $150. The squeeze case, when paper breaks and physical rules, silver shoots to 400 plus. Delivery failure case, forced settlement price reset. Nuclear scenario, hitting 600 plus, fulfilling the 50 years cup and handle technical target. This isn't a prediction, it's simple market math combined with technical analysis. Whether the repricing comes quietly or violently, we will cover every step. This is MarketVelugu, Light on Markets.